I want to bring in Dave Nadig. He is CIO and Director of Research for ETF Trends. Dave, good to see you. I want to stick with this inflation theme for a moment, and I'm curious how ETF investors are playing it right now. Are they using certain ETFs as a hedge, and are they being able to profit from this environment of high inflation?
Well, there's no question investors and advisors are really focused on inflation. October was the biggest month for inflows into TIPS products, right, which is the easiest headline way to talk about inflation. We just had 5.7 billion flow into TIPS in October, absolutely blowing the doors off the biggest previous month we've had for TIPS. Now, personally, I actually think that by the time you see big flows into something like TIPS, it's probably a little bit too late. That's always one of the adages around TIPS investing. By the time you think inflation's here, you're probably too late to profit from TIPS. So what we've seen is a lot of focus on commodities, alternative ways to get exposure to assets that may rally with inflation. The name above the title way of doing this is probably Invesco's Optimum Yield Fund, PDBC. That doesn't give you any funky tax forms at the end of the year, no K1s. It's really just an optimized basket of broad commodities exposure, a little bit heavy on energy, but it's really been doing quite well. And a lot of investors do think that we are headed for some sort of new commodities super cycle here. If you're looking to get a little bit less energy intensive, though, we've had a couple of really interesting developments. WisdomTree just added Bitcoin futures, about a 3% slot into their big commodities ETF, which is GCC. It's actively managed. And not only does it give you that little bit of Bitcoin, which may help, it also really pulls down your energy exposure and gives you a little bit more of a diversified basket. So that would be probably my lean in right now on inflation, would be to look at commodities and maybe look at GCC.
Makes a lot of sense. All right, let's talk about something else that's hot at the moment. That is holiday travel, Thanksgiving travel upon us. Where are some of the opportunities if you want to sort of play the travel ETF story?
Yeah, this doesn't strike me as a bad idea right now. We've seen turnstiles at the TSA almost back to pre-pandemic normal. I suspect as we get into the holiday season here, we're actually going to have a real boom time in broad travel. Now, there's sort of two ways to play this. If you really want to focus on airline travel, the U.S. Global Jets ETF, JETS, is absolutely the easiest way to play that. It hasn't been doing particularly well recently. A lot of the airlines are under pressure. Labor pressure, energy prices you were just talking about goes directly to the bottom of a line of a lot of airlines. But I do think that those things are rolling through the system and are pretty priced into airlines right now. So Jets is the way to do that, and it gives you a little bit of exposure to the support industries as well, the servicers, the maintenance firms, things like that. If you want to get a real aggressive play here, one of my favorite new ETFs launched in the last year or two was OOTO from Direction, stands for Out of the Office. It's a leveraged fund, which I generally don't talk a lot about, so it's 2x exposure, but the basket underneath is hotels, leisure companies like Disney, airlines are in there as well. So if you really want to make a bet on, say, the next 8 weeks here through the travel season, I think that'd be the way to do it. But boy, I absolutely want your viewers to be cautious. It is levered, and if you get it wrong, you go down twice as fast as well.
And what does OOTO stand for, Dave?
Out of the office, which I think is hilarious.
I do too. I like it. All right. What about investors searching for income in an incomeless world? It's tough out there. Do you have any tips for those folks?
Yeah, there are a couple of ways to do that. Speaking again to the inflation play, a recent launch we saw was GLDX. This comes from U.S. commodities funds, the folks behind things like USO, the big oil fund. And what this does is it gives you exposure to gold, which a lot of people look at as an inflation hedge. But by using futures and warrants, it actually strips out what you should expect to be about 3 to 5% income a year out of that gold exposure. So a little bit of way of having your cake and eating it too, if you will. Outside of that, we've seen a lot of interest in dividend strategies, as you might expect, and alternative fixed income products. I might highlight the Crane Shares High Yield Fund, KHYB, focused exclusively on high yield opportunities in Asia. Now, if that sounds scary because of Evergrande, you might be right? There has been a lot going on in the Asian debt market, but again, you look at the price, it's really been priced in at this point. The yields being advertised in the Asian bond market are, north of 7%. So we have seen a lot of folks looking there. But again, if you're getting that higher income, you should expect that you're either sacrificing something or taking a little bit of risk.
Well, we have definitely covered a lot here, Dave. But before you go, what about infrastructure-related ETFs and interest there now that we have that infrastructure bill passed?
Yeah, so there are a couple of plays here. PAVE and NFRA have been the two big plays in the space. The challenge with infrastructure investment is, despite the fact that the government is going to spend, for instance, $66 billion on railways, which I'm all for, it takes a long time for that money to show up in the hands of large publicly traded companies. A lot of that money actually ends up at the local level. That's part of why infrastructure spending is so great for the economy, because it does tend to go into the lower edge of the economy, right where people live, actual jobs on the ground, actual projects in your community. But that doesn't tend to, for instance, make the price of John Deere go up a lot. So I think infrastructure is a challenging thing to get in an ETF package. But I do think something like NFRA or PAVE is going to give you that exposure when it does show up in the equity markets.
Yeah, when it does show up, right? Those are the operative words, because it's going to definitely take a while. Dave Nadig of ETF Trends, always a pleasure. Thanks so much.